Although the following conversation is sponsored by John Hancock, the opinions and legal views expressed are those of the participants and not necessarily reflect John Hancock's views on any of the issues discussed. Please listen to the important disclosures at the end of this broadcast. On this edition of John Hancock's Advanced Markets Radio, Josh Winslow, underwriting attorney at John Hancock's Advanced Markets, will be discussing ESOPs and life insurance with Kelly Finnell, who is an ESOPs and ownership succession planning consultant and author of the book, The ESOP Coach. I'm Tanya Iddings, and you're listening to John Hancock's Advanced Markets Radio.
I'd like to welcome to the show a great new guest, Kelly Finnell. Welcome, Kelly.
Thanks. It's great to be with you this morning.
So, Kelly, we're seeing some increasing opportunities to help people who are either putting together ESOPs or are looking to find opportunities for life insurance related to ESOPs. People are calling into our advanced markets desk, and we'd love to be able to provide some more insight and guidance for them. But before we do that, can you spend a few moments talking with us a little bit about what an ESOP is and kind of how it works?
Sure. An ESOP at its heart is a qualified retirement plan. So many of your listeners are already very familiar with qualified plans because of their experience with 401ks. And an ESOP will work in general the same way as any other qualified plan, but with three major exceptions. The first exception is that an ESOP can borrow money, and it's the only kind of retirement plan that is permitted to do that. The second exception is that an ESOP can engage in certain transactions with parties in interest, and so this would be a statutory exemption to the prohibited transaction rules. And then the third difference is that an ESOP is required to invest primarily in the stock of the company that sponsors the plan. And so when you add those things together, what happens in the typical ESOP is that a company goes out and borrows money. It relends that money to the ESOP. The ESOP then uses that money to buy stock from our owner, the owner of the business, and then that stock that the ESOP has purchased becomes an asset or an investment in the employee's retirement plan. And there are all sorts of tax benefits associated with that, but that's the basic structure of an ESOP.
Okay, so they're borrowing money, and that's because it provides the opportunity to actually bring cash flow into the business without actually having an expense on the books of the business it's associated with?
Yeah, it brings cash into the ESOP so that cash generally can go out to the owner to provide him liquidity. So ESOPs are usually structured for baby boomer business owners that are looking for exit strategies and the opportunity to realize the value of their life's work. They transition the company to the employees in a tax-advantaged way, and they get cash to fund their retirement needs.
We're seeing some increasing activity, and I don't know if that's just the phone calls we happen to be catching or whether there's actually more activity going on in the area. What's the current state of activity in the ESOP community right now?
Yeah, no, this is not just a coincidence that you're getting more calls about this subject. There was a PricewaterhouseCoopers study that came out recently in a publication that they do called Trendsetter Barometer, and that publication is a study of smaller, closely held companies. And that study indicated that ESOP activity is up almost 300% over the last few years, and that certainly would be borne out by our experience. That's all we do. We have an ESOP consulting firm, and our business has really boomed over the last 2.5 years. And it would also be borne out by my conversations with other people in the ESOP community. So, yeah, activity is really up.
300% increase is certainly a great opportunity out there for some folks, and it explains some of the increases we're seeing. And I'm assuming that, well, like everything, the American Taxpayer Relief Act of 2012 made subtle changes to a little bit of everything we talk about and everything we do.
Yeah.
But the tax law changes, how did they affect the ESOP community? And are we going to see more activity, over 300% increase, or are we seeing a little bit less than that maybe as a result?
No, I think that the new tax law is just going to accelerate interest in ESOPs. One of the tax benefits of an ESOP is that a business owner has the opportunity to sell the stock that he or she owns in their company on a tax-free basis by selling it to the ESOP and then reinvesting those proceeds under Internal Revenue Code Section 1042. And so as a result of the tax on capital gains increasing from 15% to 20% under the new tax law, and then the new Medicare tax being applied to gains on the sale of stock, and that being another 3.8%, we've got an almost 60% increase in the taxes that would be due on the sale of my closely held stock. So we've gone from 15% federal to 23.8%. And so that's just going to make the ESOP's tax advantages that much more attractive, and I think will spur even more ESOP activity.
That sounds like a much improved opportunity over what was already a highly active and very important opportunity for folks. Could you describe a little bit about kind of who are the candidates? I mean, I'm sure the folks that are listening here are understanding how to talk a little bit about this with folks, but we're not sure necessarily who we should be addressing it for. You know, I think of ESOP, and the only thing I think of is some of the very large programs that are out there, but I understand that it's moving into small and mid-sized companies and really becoming a great opportunity there as well.
Well, that's right. Traditionally, Josh, ESOPs were adopted by large public companies, but the change in the tax law that happened in the 80s when 1042 was added to the code in 1984 has caused closely held companies to be interested in ESOPs. And now the Taxpayer Relief Act, as we discussed, is just going to accelerate that. So the focus of our practice is on closely held companies, and typically those companies are owned by baby boomer business owners. So those people that were born between 1946 and 1964 who have developed a company and are now, because of their age and getting close to retirement, thinking about how they're going to realize the value of their life's work. So an ESOP gives them the opportunity to have a value-realizing event and convert the stock in their closely held company to cash so that they can fund their retirement income needs. One of the requirements for an ESOP is that the company have a strong successor management team. And so an ESOP is essentially a transition or sale to insiders. And so one of the things that's really important in an ESOP candidate is that there be strong second-line management so that when the owner sells out, there are other people there that can run the business in his or her absence. One of the things that is very helpful, since an ESOP is a leveraged transaction, it's very helpful if the company has a low level of debt currently so that it has some excess debt capacity that it can use to fund the ESOP. And finally, as a general rule, you want there to be at least a sale of $3 million worth of stock to the ESOP. And so ESOPs don't work well for micro companies, but work better in a situation where you have a company that, might be worth $10 million and the owner wants to sell 30% of their stock, or where you have a company that's worth $3 million and they want to sell 100%. So as a general rule, you need to sell about $3 million worth of stock in order for it to make sense.
Certainly helps our understanding as to where this fits into the marketplace. We do a lot as a state and business planners. We do a lot of speaking with folks about business succession strategies and buy-sell arrangements, and this sounds like an enhancement over what would traditionally be considered more of a one-way buy-sell arrangement where the next generation of leadership is truly buying out the senior leadership of a company, be it, as you said, a $3 million or $30 million company. Is that a decent surrogate for kind of where an ESOP would come in? Is if I'm looking at a buy-sell, an ESOP might make sense?
Absolutely. It's an ESOP works very well as an alternative to a management buyout or to a leveraged redemption. And the reason it works well in those situations is because of its tax benefits. An ESOP is very similar to a leveraged redemption or buyout in terms of its structure and the needs that it satisfies. But with an ESOP, you do that transaction on a much more tax-advantaged basis because the company gets a tax deduction not just for the interest that it pays on the financing for that leveraged buyout, but it also gets a tax deduction for the principal payment. And it's the only place in the Internal Revenue Code where a company can get a tax deduction for the principal payment on the loan. And the way that principal becomes tax deductible is because the company funnels what would have been a principal payment on a loan into the ESOP as a retirement plan contribution. And so as long as it's within the 415 limits, that contribution to the retirement plan is a tax-deductible expense for the company, and then the ESOP uses that money that it's received on a tax-deductible basis to repay the loan. And so you can reduce the cost of a management buyout or a leveraged redemption by 40%, the tax rate that would be applicable to the company.
That's a fantastic reason to consider an ESOP. Now,
Yep.
One of the ways we historically have funded some of those buyout arrangements is to use life insurance. And I always have to look to see if I can find an opportunity for life insurance when one presents itself. Is there an opportunity within the ESOPs to use life insurance? I heard you say that the majority of the assets, or primarily the assets of an ESOP, need to be the stock of the business. So I wouldn't even know if it's inside of that or outside of that. But do you know where life insurance can be a part of the ESOP strategy?
Yeah, it's typically used outside the ESOP, and the insurance is purchased by the company. And there are several reasons why ESOP companies really need to own insurance. The first reason is because of this debt that you've created. You know, whenever a company takes on new debt, and in the ESOP, a lot of times the company is taking on debt equal to the value of the business. And so if you have a $10 million fair market value company that's going to borrow $10 million to buy out the owner, guess what? That company needs $10 million of insurance on the owner's life. The bank wants to make sure that it's going to get repaid if something happens to that selling shareholder. And a lot of times the owner is going to be taking back seller debt. So he's going to get an IOU for the ESOP. So he might get $5 million in cash funded by a bank loan and then $5 million in seller debt. And so it's imperative that the company have $10 million of insurance so that if something happens to the owner, the company has the cash to pay everybody off. And if you have a bank that's paying attention to what's going on, they're going to require that. Next place where insurance has an application in an ESOP company is for what's called the ESOP's repurchase liability. You know, I said at the beginning that an ESOP is a form of qualified retirement plan. But when you think about it, there's really no cash in the ESOP to fund employees' retirement income because the investment of the plan is this company's stock. So the law requires under Section 409H of the Internal Revenue Code that when an employee has a distributable event, that the company convert the stock that's in the employee's account into cash. And so that is very similar to funding a non-qualified retirement plan benefit. And as you and your listeners know, one of the most common ways to fund a non-qualified retirement benefit is through the use of COLI, or corporate-owned life insurance. And so that's another application for life insurance. And then finally, I would imagine that many of your listeners are probably in the investment space as well as insurance. And we've just created a lot of liquidity for our business owner that needs to be invested as a result of this ESOP.
Certainly. So those financial advisors as well are finding opportunities once the transition's taken place. From the company stock perspective, we're transitioning the company from the owner to the next round of owners. But how do they value that? How do they determine what the appropriate value of a company is for an ESOP plan? Are there special rules in place or a process that's traditionally the practice?
Yeah, really both. The law requires that the value of the company be determined by an independent professional appraiser. And so the ESOP is going to have a trustee. And that trustee, usually a financial institution, is going to hire a valuation advisor. And that valuation advisor is going to get all of the information about the company's financial situation, and it's going to value the stock on an independent basis and tell the trustee how much it can pay for the stock that it's purchasing from our selling shareholder. And so that, in essence, is Congress's way of creating an arbiter, a third party, to determine how much is going to be paid, because obviously the owner, the selling shareholder, wants to get as much as possible, but it's not fair to the employees who are participants in the ESOP for the ESOP to overpay. And so the law requires that we have this independent third party who's objective and neutral determine what the value of the business is.
All right. Now that I understand kind of how the value is determined and the $3 million to $30 million businesses we were talking about before, the question that's coming to mind for me is to obviously understand. You mentioned that it's done through a loan, but I'm curious if there's a little more. But you could tell us about how do the participants kind of finance the ESOP plan? It's a loan, but I'm sure there's more to it than just that.
Yeah, and the financing is really done by the company for the benefit of the participants. And so the company would go to its bank and say to the bank, look, we've got the three things that bankers are interested in. We've got cash flow, we've got collateral, and you're comfortable with the credit, with the character of the leaders of the company, because we've been doing business together for several years now. So you're comfortable with all of that. And based on that, tell us how much money you would loan the company for the company to implement this transaction. And so if you have a service business, that service company is probably going to be shy on collateral because its assets walk out the door every night at 5 o'clock because its assets are its people. And so in a service business, the company might be able to borrow 40% or so of its value. So on a $10 million company, you might be able to borrow $4 million from the bank, and the owner would get that cash at closing and would get, in addition to that cash, a promissory note issued by the ESOP. And that promissory note would be for the remaining $6 million. If you have a manufacturing company that has property, plant, and equipment, then those are the kind of assets that banks like. And so in that situation, you might be able to borrow 60 to 80% of the value of the company. We actually had a manufacturing company last year that borrowed just over 80% of its value. And so in our example, the selling shareholder got $8 million at closing plus a $2 million promissory note. And so, of course, banks want to get repaid when they loan money, and so the company is obligated to make contributions to the ESOP in an amount equal to the annual debt service. And so that money goes from the company to the ESOP on a tax-deductible basis, and the ESOP then repays these loans.
One of the things about loans that certainly is going to come to mind for many of our listeners is how tight these credit markets have been and how difficult it is to get some lenders to extend credit even in today's market. It's been at least a couple of years now. Unfortunately, I'm almost able to say multiples of a couple, but we'll leave it at a couple for now. But I'm wondering, are there types of institutions or in general, are you finding that ESOPs are something that lenders find are an appropriate risk and are comfortable lending to even in today's tight credit markets?
Yeah, let me tell you about my experience. Obviously, in 2008, with the bankruptcy of Lehman in the fall of that year, there was a tremendous contraction in the credit markets. And so very little happened in the last quarter of 2008. Nothing happened in 2009 or in 2010. The credit markets were dead. And so during that period of time, we were continuing to do ESOPs. We didn't do as many as we would have done without the credit crunch. And most of those ESOPs were completely seller financed. And so we had no bank financing, and we had owners that sold in exchange for the promissory note that we talked about. But beginning in 2011, we saw the credit markets starting to unthaw for ESOP loans. And then last year in 2012, we were able to get 5 ESOP loans for our clients that had terms almost as aggressive as what we would have seen before the credit crunch occurred in 2008. And so we got 5 ESOP loans, and none of them had personal guarantees for the selling shareholder or for any of the successor management team. So in my view, at least as far as ESOPs are concerned, the credit markets have fully unthawed. And almost return, not quite, but almost return to where they were before '08. There is more careful underwriting than there was before '08. And so banks are doing a tremendous amount of due diligence. But if you have a strong company that is credit worthy, we have found that they're able to get the loans that they need to finance these transactions and get them on very favorable terms.
So it sounds like the good candidates can still get the same type of loans that we were able to get pre-2008. And
That's right.
And it just might take a little more documentation along the way.
That's exactly right. That's been exactly our experience.
You know, I'm thinking through kind of the other challenges people might have, and I return back to some of my original comments here. This is striking me a lot like the buy-sell arrangements I'm more familiar with. And as I think it through, I think one of the biggest challenges that anybody talking with clients about a buy-sell arrangement will come across is that there's concern about the transition of ownership, or more importantly, the transition of control of a business. Anytime you're talking buy-sell and someone's losing control of a business they built, they get worried that they're going to change the business, or the business is going to start changing despite their continued involvement. In the ESOP, because that transition is going to take place over time, or the transition of ownership takes place over time, how does the transition of control take place? Are there pieces that an owner can put in place, or does it run through the balance of the ownership of the company?
Well, no, you hit the nail right on the head. The transition of control is generally over time as well. And so all of the business owners that I deal with insist on having control until all of the ESOP debt is paid off. And so that's the way almost all of these transactions are structured, so that the person that is selling their stock and selling almost always part of it in exchange for a promissory note, that seller has complete control of the business until the last penny of that promissory note is paid off. And so in the ESOP gives us a way to transition, as you correctly said, ownership and control over time. And that's what we found most business owners want and need when they're doing a transition to insiders, and it gives them a way to gradually phase out of the business instead of exiting immediately.
I appreciate all the great information, and while I understand a lot more, certainly I'm not ready to go it alone just yet, and I suspect we got some listeners who are going to be in roughly the same place. So where can I get more information about ESOPs when I find a good candidate? Because I certainly understand more about what candidates I'm looking for. And if a candidate's interested in an ESOP, is there someone I can bring in to kind of help me through this process?
Yeah, let me start with a couple of good websites that your listeners can go to. First, I'll direct you to our website. I've written a book on ESOPs called The ESOP Coach. And so you can go to our website, ESOPcoach.com, and get a lot more information. You can go to Amazon and order a copy of that book. There also is a great educational organization called the National Center for Employee Ownership, or NCEO. And that organization has a lot of great information on its website, which is nceo.org. And so that would be two good places to start. And I would also, welcome your listeners to call or email us if they have more specific information that they can't get from one of those websites or from the book.
Well, Kelly, we certainly appreciate your time today, and I know I have a lot more reading to do here in the coming days, but we certainly appreciate your time and your insight on how an ESOP works and how an ESOP can benefit both the business owners and the managers who are going to be taking over a business.
Well, Josh, thank you very much for this opportunity. I've enjoyed our conversation and wish you all the best.
Thank you, Kelly and Josh. If you would like to hear more about today's discussion, or any of the other past topics covered on this program, go to jhamradio.com. That's jhamradio.com. I'm Tanya Iddings, and you have been listening to John Hancock's Advanced Markets Radio. For the financial and professional use only, not for use with the public, insurance products are issued by John Hancock's Life Insurance Company, USA, Boston, Mass. 02116.